Welcome back to Sensibility. Today, my friends in finance, I want to talk about how volatility impacts value and why a company like Berkshire Hathaway has been able to deliver outsized returns for almost 55 years, while often having lower volatility than the market itself. For example, think about how the market reacts to earnings. When Berkshire Hathaway reports disappointing numbers, the stock might dip a few percent in a day, but it usually doesn't swing wildly. In contrast, when Amazon reported earnings recently, the numbers were actually solid, but the market's worried about slowing growth, and the stock fell more than 6% in just a few hours. So why the difference? For most companies, lower volatility comes from things like diversification and large cash reserves. Berkshire has both, but there's another factor at play: investor mindset. Berkshire shareholders often think in decades, not months. Many investors buy the stock because they believe in Warren Buffett's philosophy and plan to hold it for a decade or more. Compare that to a market as a whole, where the average holding period is often less than a year. Amazon, on the other hand, attracts growth-focused investors who are quick to react if the story changes. If the company reported negative earnings, many would likely sell right away. Berkshire shows us that a company doesn't just create value by growing. It also creates value by reducing volatility and attracting patient, long-term shareholders. Over time, that steady compounding can be just as powerful as flashy growth. Obviously, volatility isn't the only or the most important factor to consider when investing, but it is definitely worth considering the next time you go to purchase something for your portfolio.
Thanks for watching. Remember, this isn't investment advice, just stuff you should know. Please like, share, and subscribe so that you and I can continue our investing journey together.